Do stock splits increase the value of a company? When are stock buybacks just awful for investors? And how can you easily create a password that not even the NSA can crack? We'll answer these questions and more on this, the 60th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, I'm Rob Berger, host of the DoughRoller Podcast. Welcome to the 60th episode. It's hard to believe we've hit the number 60. It seems like it won't be too long. We might hit that magical 100th episode. So it's been an exciting ride. I've still continued to get a ton of email from folks, and I appreciate it. And in fact, to some extent, the topic today has been inspired by not one email from a listener, but actually several that have kind of raised different questions about aspects of stock dividends and stock buybacks and stock splits. We're going to cover them today, in part because yesterday, Apple announced its second quarter results, and some big news in that on that front. They're increasing their dividends, they're increasing their buybacks, and they're doing a 7-for-1 stock split. So I thought now would be a good time to talk about each of those, and in particular in the context of Apple's announcement. So we'll get to that. Hey, before we do, though, a couple of things. First, if you don't follow DoughRoller on Twitter, I'd highly encourage it. You can do that. It's real simple. It's at DoughRoller. That's the Twitter handle. And what I do with Twitter is I'm sometimes better than others in terms of getting stuff pushed out through Twitter. What I like about Twitter and how I use it is I don't tell you what I'm having for lunch or how bad traffic is as I'm trying to get to work. I don't really use it that way. Some do, and that's fine. Some folks love to have conversations on Twitter. That's just not me. The best way to talk to me is in an email. For Twitter, what I do is I send out links. When I find articles on the internet that I find interesting or helpful in the world of personal finance and investing, I usually send out a link to that article through Twitter. I will also send out links to content that I publish on DoughRoller, but frankly, the majority of it is for news and articles that I find on other websites. That's what I use Twitter for. If you're interested in that, you can follow me. Again, it's at DoughRoller. That's on Twitter. Okay, let's move right to the money tool of the day. I really set myself up on this when I asked at the top of the show, how can you easily create a password that not even the NSA can crack? I may have been overstating it just a bit. I'm kind of guessing the NSA could probably crack these passwords, but it is a very easy way. Imagine if all your passwords were 15 characters long, and they not only had letters, capital, lowercase, they had numbers, and they had punctuation and other characters. Well, you wouldn't be able. The problem with that is they'd be hard to crack, at least through a brute force attempt. It would be probably statistically impossible, actually. But how would you remember it? That would be the problem, right? You couldn't remember that password. And of course, you want a password that's different. We talk about our finances being online. You have online banking. You have your online broker or mutual fund companies. You probably can log into your 401k at work or your 403b at work. And so, these are really, really important, obviously important sites and information that you have that have a significant impact on your finances. And so we want to keep them secure. We want different passwords for each of them. We don't want to use the same password for all of them because, if one person cracks it, they crack all your passwords. You don't want that. You want it sufficiently long enough and complex enough that it can't be easily guessed. But again, the problem is once you do all of that, how do you remember them? Well, I have a free tool that I use that, to my surprise, as I talk to folks, a lot of people haven't heard about it. I think it's a great tool, and it's called LastPass. And you can go to their site, lastpass.com. And basically what it does, in your browser, you can create a bookmark, if you will. And what it will do is it will allow you, first of all, to generate passwords for each of the sites that you log into. And they don't have to be about personal finance. You could use this for your password on Facebook or for your email or whatever. And there are settings as to how complicated you want the password to be, how long you want it to be. Do you want it to include punctuation and other characters or not? And that's very easy to do. And then you generate the password and it will save it for you. Now, you might be saying, well, wait a minute. What if LastPass? What if, if LastPass has all my passwords? What if someone cracks LastPass? Then they have all of my passwords. Well, that's not exactly how LastPass works, and I will be the first to admit that I do not understand the technology. But I'll say this. You have to, of course, create a password for LastPass. Once you log into LastPass and then you go to, let's say, your banking site, it will automatically populate your username and password for that bank. And you may be saying, well, what if you lose your password to LastPass? You think, well, like most sites, LastPass probably has a way for you to retrieve your password. Not true. LastPass doesn't actually keep the password. It doesn't even keep your password to LastPass. So you say, well, wait a minute. If I lose my LastPass password, I can never get back in. And the answer is, that's right. You would have to go and reset all of your passwords to all of the different sites in which you used LastPass. Now, that may seem like a real headache, but it's one of the ways that LastPass keeps your information secure. They don't hold on to it. They use encryption and other tools to maintain the passwords that you save in LastPass, and that get populated when you visit a website. But you have to actually log into LastPass on your computer using the password that LastPass doesn't even keep. And then you'll have access to all of the passwords you've saved. Okay, I know I've made this sound far more complicated than it really is. LastPass is very, very easy to use. They do have a premium version that I think allows you to use LastPass on smartphones and tablets and that sort of thing. I don't actually use that. To use it on your computer or your laptop, totally free. I think it's definitely worth checking out. It's allowed me to have incredibly complicated passwords for all of the sites that I access, not just my financial sites. And again, you can find this tool at lastpass.com. Okay, on to the main topic, dividends and buybacks and stock splits. We're going to kind of cover each of them quickly in the context of Apple. So what happened with Apple? So yesterday, and I'm recording this the day after this announcement. It'll actually go live a couple of days later. But Apple had an announcement. It announced its second quarter results, which were quite good. Their revenue was up, their earnings were up, their sales of iPhones increased, which surprised the market, and that's fairly significant for Apple because, one, it's their biggest product, generates the most revenue, and most believe that its margins on iPhones are quite high. Some believe they're higher than 50%, which is just phenomenal. And so to see an increase in iPhone sales, particularly when there were no new product releases in the past quarter, really gave the market some confidence in the future of Apple. Now, I don't tend to get too excited about a single quarter's results, but it certainly was a nice thing to see. As I always do when I talk about an individual security, I do disclose whether I own shares of the company, and I do in the case of Apple. I've been a fairly long-term investor in Apple stock, and so I follow it fairly closely. And it was certainly a very positive quarter for Apple, and that was good to see. But what they did as part of their announcement is they announced that, one, they were going to increase dividends. We'll talk about that in a minute. They're going to increase their stock buyback program. We'll talk about that. And they're going to split their stock 7-for-1. So let's start there. What the heck is a stock split? Actually, let me back up. Before I get to stock splits, I want to say one other thing. Dividends and buybacks and stock splits matter whether you own individual shares of a stock, like Apple in this case, or whether you own those shares of that company through a mutual fund or ETF. This matters. It doesn't matter whether you invest in individual stocks or through mutual funds and ETFs. When a company, particularly one as significant as Apple, increases its dividends, increases its buyback program, splits its stock, it affects your investments. Now, of course, when you own a mutual fund and an ETF or an ETF that owns hundreds of different companies, its impact on any given fund isn't as significant, but it absolutely affects investors. Again, whether you own these shares directly or through a mutual fund. Okay, so with stock splits, let's talk about that first. A stock split is nothing more than when a company divides its existing shares into multiple shares, and then it reduces the price per share by the same multiple. Now, let's give an example because that may have gone right over you. A common stock split is 2-for-1. So let's imagine you own one share of a company and it's trading at $100. If the company were to do a 2-for-1 stock split, what they would say is, hey, give me your one share. I'll take that. Thank you. And in place, I'm going to give you 2 shares. There you go. Now, what I'm also going to do, though, is your one share that I took away from you was trading at $100. I'm going to give you 2 shares to replace it, but they're each going to only trade at $50. So the value of your ownership and the percentage of the company that you own hasn't changed a bit. I've simply replaced your one share with 2 shares and reduced the price accordingly. There can be a 3-for-1 stock split, a 4-for-1 stock split. In the case of Apple, they declared a 7-for-1 stock split. So for each individual share that I own, they're going to give me 7 shares. But again, the price of each of those shares is going to be reduced so that my overall value hasn't changed. The percentage of the company that I own hasn't changed. It's simply now represented by 7 shares rather than 1. Now, given that, you may say, well, why do companies bother with stock splits? Well, some of them don't actually. One of the companies that generally doesn't split its stock is Berkshire Hathaway. At least its A shares. They don't split their stock. The B shares, they've split those. We'll talk about that in a minute. But not every company actually does split its stock. And Berkshire Hathaway, at least its A shares, is an example of that. But why do some companies, and by the way, I should say a single share of Berkshire Hathaway, A shares, currently trades at $190,000. Yeah. They haven't split their stock. It's gone up nicely over the last few decades. Okay, so why do some companies, including Apple, split their stock? Well, probably the primary reason is to make their shares more affordable to retail investors. So before the stock split, Apple is trading at about, 500. They were at about 520, 530. After their announcement yesterday, it's probably going to bump to 560. And so by declaring a 7-for-1 stock split, that's going to reduce the price by 7-fold. And the theory is it makes it more affordable for retail investors. Personally, I think I just don't like that. I don't like to split stock to try to make it more affordable for retail investors. The fact is, I think the vast majority of people can invest in Apple if they want to. You can buy fractional shares through some brokers. I just don't like it. You know, the theory is it may increase liquidity, and there could be some truth to that, although the reality is the liquidity of Apple stock is phenomenal. But that's the theory. It makes the shares of a company more affordable to retail investors. That's one reason. Sometimes there are transactional reasons. I mentioned Berkshire Hathaway. They don't split their A shares. Back in 2010, though, they did split their B shares. I think at the time, the B shares were trading, I want to say, around $3,000. And they split them. I don't even remember what the split was, but it took them down to under $100 a share, as I recall. Why did they do that? Well, it was actually part of their acquisition of Burlington Northern. It involved some of the B shares and getting shares to some of the Burlington Northern investors, I believe. And they needed to bring down the price of the share and it's the ownership that it represented. So they did a stock split for part of that transaction. So sometimes that can happen. Here's the other thing. Sometimes management splits stocks to increase the share price to benefit their own options. You know, what do I mean by that? Well, when a company splits its stock, it tends to increase what the market will pay for one share of the company. Now you say, well, why does it do that? I mean, it doesn't increase the ownership percentage. It just, if you had one share and they replace it with 7, you haven't increased your ownership interest in the company. You've just replaced it with 7 shares with what used to be 1 share. Why would that increase the price of the stock? Well, it just does. The market seems to like stock splits. Is it rational? No, not really. But they seem to like it, and management knows that. And sometimes management wants to boost the prices per share so that they can make their options more valuable. Now, that's that's the cynic in me. But I think it's a fair characterization of some stock splits. Now, I don't mean to suggest that's why Apple did it. But that is sometimes why companies will split their stock. Now, as I said, I'm not generally a fan of stock splits. They don't add value. They don't change the intrinsic value of the company. They don't change my ownership interest in the company. I'm not, upset that Apple did a 7-for-1 stock split. I just generally, though, think that they don't add a value for investors or for companies, the intrinsic value of a company. But, you'll see as we follow Apple and the 7-for-1 stock split, it will get a lot of news and a lot of attention. Really, stock splits kind of remind me of Yogi Berra, the famed New York Yankee catcher. He's got a lot of quotes like, it's deja vu all over again, or when you come to a fork in the road, take it. Well, he has one that's actually relevant to stock splits. He said, you better cut the pizza in 4 pieces because I'm not hungry enough to eat 6. That's kind of like a stock split. It doesn't really matter how many pieces you cut the pie into. It's still the same amount of pizza. The same is true with stock splits. There you go. Whatever I think about stock splits, Apple's splitting their stock 7-for-1. Okay, now dividends. Apple also announced that it was increasing its quarterly dividends by 8%. Previously, their quarterly dividend was $3.05 per share, and they are increasing that to $3.29 per share. And so let's talk about dividends and how this helps or hurts investors. So first of all, dividend can be a cash dividend or a stock dividend. You can pay dividends in the form of shares. Most dividends, when people talk about dividends, they're talking about cash dividends. This is when the company returns some of its cash to the shareholders by writing them a check and sending them cash. Now, let's think about dividends sort of more conceptually. So, companies, hopefully they're making a profit. Hopefully they have positive cash flow after their expenses. And what do they do with this profit, their cash flow? Well, you can think of a company. They tend to do one of 3 things with their profit, with their cash. The first is they could have capital investments just to maintain their existing business, right? Occasionally, they've got to replace their computer systems, and they have to upgrade their software. And maybe if they have a factory, they need to upgrade or even replace their equipment and the machinery and upgrade facilities. These sorts of things aren't intended to expand their business. They're simply to maintain the existing business that they have. So that's important. The second way they'll use their cash is to actually expand, to grow. Maybe they'll build a new plant. They'll, if they're a retailer, they will open up new stores, and they will invest in research and development. So that's the second way, is to actually expand and grow the business. And then the third way, and I'm kind of generalizing this, but these are sort of the 3 major ways, if you will, is they can get to a point where they say, you know what, we've taken care of all of our capital needs to maintain our existing business. We've invested money to grow our business in ways that we think make sense, and we have some cash left over. So we're going to return some of it to investors in the form of dividends. So what that means is that it's usually the more mature companies that have grown and maybe their growth has slowed down a bit that start to return dividends, start to return cash to shareholders in the form of dividends. It wasn't that long ago when Apple didn't pay a dividend. And that made sense at the time. They were growing. They were introducing new products. Recall that some time ago, they started opening up retail stores. That requires capital. But they got to a point where they had so much cash, they couldn't invest it all in future business. And so they finally said, okay, it's time to return some cash to investors, and they started paying a dividend. And of course, now they're increasing that dividend. Compare that to, say, Tesla. And I'll disclose, I own exactly 1 share of Tesla. There's a story behind that, but more about that later. Tesla is growing, right? They are trying to build a battery factory. They are launching plan to launch new vehicles, new cars. They are building charging stations throughout the country. They are recently announced they're trying to expand into China. So they're not anywhere close to returning cash to investors. They're maintaining their existing business while at the same time trying to expand. They are years away from returning cash to investors in the form of dividends. So back to Apple, they increased their dividends, as I said, by 8%, which is huge. a very significant increase in their cash dividend to investors, and it is a very common and great way to return cash to investors. Now, just real quick, a couple of things to think about when you're looking at your own investments and dividends. One is the dividend yield. That is the dividends per share, right, divided by the price per share. So in the case of Apple, you'd take the $3.29 quarterly dividend, you'd multiply it by 4 to get the annual dividend, and then you'd divide it by its price per share, and that would give you its dividend yield. And dividend yield can be helpful just to get a sense of the return. It can help you compare one company to another. You've got to go a lot deeper than just the dividend yield, but it can help you get a sense as to what percentage of your investment in that company might come back to you in the form of dividends. Obviously, the yield can change significantly without the dividends per share changing at all, right? Because it's a ratio of dividends per share to price per share. So as the price goes up or down, the dividend yield will change significantly, right? As the price goes up, the dividend yield will go down. As the price goes down, the dividend yield will go up. So that's one factor to think about with dividends. The other one is the dividend payout ratio, which is simply the percentage of earnings paid to shareholders. And you calculate that by taking the annual dividends per share divided by the annual earnings per share. Now, why is that important? Well, companies want to maintain the dividends that they're paying and to even increase them each year as a way to show that the company is doing well, to have shareholders continue to have confidence in the company. And that's fine, except that some companies, to do that, will stretch and really pay out more and more and more of their earnings in the form of dividends. And the reason that can be an issue is it can be a sign that maybe they're getting to a point where they may actually have to cut their dividends. If they're calling it too close, if they're paying out too much of their earnings in the form of dividends, it can be a sign that maybe there's trouble. And so that's something to look at, dividends, the dividend payout ratio. And again, you can find this on Morningstar. You can find it really on Google Finance, CNN Money. These both the dividend yield and the payout ratio are available on these sites. Very easy to find. I'm actually looking up Apple as I record this. Of course, it's going to change as we go forward. But let's see here. Dividend yield 2.32%. We'll see how the they're going to increase their dividend, which would normally increase the yield, except the price is also going to go up. So their dividend yield could stay the same. It could even go down while their actual dividends they're paying go up by 8%. But in any event, it's worth checking out. And then the other thing I'll say about dividends is, I reinvest all of my dividends back into the companies that declare them, mainly for just convenience. At my brokerage account at Vanguard, they do it for me for free. I also have a brokerage account at Options Express, and they reinvest the dividends for free as well. Most, I think, brokers do. It's definitely something to make sure of before you decide on a broker, but it makes reinvesting that money very easily. You don't have to do that. You don't have to automatically reinvest your dividends. If you're in retirement, you may live off your dividends, or particularly as your portfolio grows and the amount of dividends becomes more significant, you might want to reinvest those dividends in other companies or other mutual funds and ETFs. You may not want them automatically reinvested, but that's what I do. It's just easy. I don't have to worry about it. It gets done for me. All right, stock buybacks. So a buyback is pretty simple. A company buys back its own shares. That's simple enough. Now, the real question, though, is why in the world would they do that? They've got this extra cash. Why not pay it to investors in the form of dividends? Why go buying shares off the market? Why would they do that? Well, the first reason is it's a great way to return value to shareholders. Now, it may seem counterintuitive. You may say, wait a minute, isn't that what dividends are for? How does a buyback help me? I'm not selling my shares. They're not buying back my shares. So how does a buyback help shareholders? Well, a perfect way would be an example. Let's say you owned a small company. There were 100 outstanding shares, and you owned 10 of them. And there were 10 investors. They each owned 10 shares. So you own 10% of the company. If there were profits that were distributed, you'd get 10% of the profits. And let's assume that some of the shareholders wanted to sell out, and so the company decided to buy back 50 of the 100 shares. So they bought them back. Of course, the company had to use its cash for whatever the price of the shares were, whatever the agreement was. And then when they bought them back, they retired them. They didn't reissue them to other people. They retired them. They're gone. Well, now what's your ownership? Well, you still own the same 10 shares, but there are only 50 now outstanding shares. So your ownership in the company has gone from 10% to 20%, right? Number of shares didn't change, but the ownership percentage that those shares represent has changed. So now when the company, say, distributes earnings, you're going to get 20% of the earnings rather than 10%. Now, that sounds all good and well, and that is how stock buybacks can return value to shareholders, because the same is absolutely true with a company like Apple. While I don't own 10% of Apple, boy, I wish I did. In fact, my ownership interest, I don't know what it is, but I'm sure it starts with a decimal and then a whole bunch of zeros and then maybe a 1 at the end. When Apple buys back shares, it increases the ownership interest that my existing shares have. And so what that means is it increases my take of the company's net income. Now, you say, okay, but is that a good deal? Let's go back to our example of a small company that has 100 shares. Well, is it a good deal when the company bought back those 50 shares? And the answer is, it depends. Like any investment in stock, it depends on what they paid. And that's where buybacks can get companies into trouble. It's not uncommon for management to buy back shares when the shares are overvalued. Now, you say, well, why would they do that? Well, a couple of reasons. One is, management of a company, they're no different than you and I. Just because they have a lot of letters after their names, like CEOs and CFOs and COOs, doesn't mean that they aren't as swayed by the market as everybody. And when they see the price of their company's shares going up, they sometimes assume it's just going to keep going up forever. And they just make bad investing decisions. And they overpay for their company's own stock. And that hurts shareholders. Another reason is sometimes management will buy back shares because they want to increase the value per existing share regardless of what the price is for the stock. Why? So they can increase the value of their options. Again, that's the cynic in me, but I think it's a reality. Now, in the case of Apple, I think their buyback program has been executed quite nicely. I do not think their shares are overvalued. That's my opinion. I wouldn't say they're as undervalued as they once were. I mean, I paid under $400 a share for the stock that I own in Apple just a year or so ago. But I do think that the price of the stock is at a point where the buyback program makes sense. That's my opinion. You may have a different opinion on that. But that's where buybacks are kind of, they can be great for shareholders, but here's what it comes down to. The price that the company pays, are they buying undervalued shares or at least fairly valued shares? Or are they paying way too much for their own stock, which will in the long term hurt investors? That's the first question. The second question is, when they buy the stock back, what are they doing with it? If they're using it to acquire businesses they have no business buying in the first place, reissuing the stock for that kind of purpose, it just sends the stock back out into the market and does shareholders no good. Sometimes they'll use it to fund employee compensation plans, and that can be okay as long as these employee compensation plans are well thought out. Okay, one last thing, and that is, okay, we know what buybacks are. We know when they could be good, when they could be bad. We know what cash dividends are. How do you compare them, dividends versus buybacks? Why one or the other? Why is Apple doing both? Well, a couple of things is from an investor perspective. The first is a buyback. Again, when a company buys back the stock, particularly when they buy it back at a fair value or at a great value, as undervalued, and they don't do dumb things with the stock once they acquire it, it increases our ownership interest in the company, and it does it tax-free. There's no tax consequences to an investor when a company buys back its own shares, which is why buybacks, well executed, are fantastic for investors. Now, here's the problem. They don't feel as good as dividends, right? When the company's actually sending you a check, even if you end up reinvesting it automatically and never actually physically see it, it just gives us this sense of, we're getting something back for our investments. And buybacks don't give us that same feeling. This is when feelings can be deceiving. Buybacks are fantastic when well executed. They are tax-free to the investor, and they absolutely increase our ownership interest in the company. They increase our right to the net earnings of the company, and they increase, by the way, our take of future dividends, right? Because there are fewer shares out there to receive those dividends. Buybacks are great. Now, I love my cash dividends too. Yes, they can be taxed depending on your tax bracket. I had a reader ask me, how are dividends taxed? I'm not going to dive into that today. I'll make that a separate podcast. But if you're a long-term investor, your dividends are most likely going to be qualified dividends, which means they will qualify for capital gains treatment. And so you'll get some tax advantages there, but you're still, in most cases, paying taxes on those dividends, at least if you're holding the stock in a taxable account. So there are tax consequences, potentially tax consequences for dividends. But the thing I like about dividends is, one, they're typically paid by stable companies. If you see consistent dividends and consistently growing dividends, it shows you that management really cares about investors. They're thinking about the shareholders as they manage their cash, as they manage their business. And so I think in the case of Apple, I think it's great they're doing both. But personally, if I had to pick one over the other, I would pick buybacks, as much as I love those cash dividends. But that's just to give you a sense as to the difference between buybacks on the one hand and cash dividends on the other. And with that, we bring this podcast to a close. There's the music. Hey, if you have any questions about this, don't hesitate to shoot me an email at dr@DoughRoller.net. Happy to get your emails. I respond to everyone. If I've missed you, that means I've probably just lost your email somewhere, so don't hesitate to send me another email and say, Rob, what's up, man? You missed my email. I want an answer. Happy to receive that second email. I get those from time to time when an email falls through the cracks. Please don't take it personally. It just means that I'm going crazy here. So shoot me those emails. If you haven't already, you can subscribe to the podcast. It's easy to do. Just go to DoughRoller.net/iTunes. That will redirect you to the iTunes page where this podcast resides. And if you haven't yet, please leave me an honest rating and review on iTunes. It helps me make the show better. Hey, until next time, remember, the best thing money can buy is financial freedom.